Hello and welcome back to Riding Academia. We're going to be looking at the balance sheet, okay? In our previous video, we have looked at the statement of comprehensive income where we treated prepayment and then accruals, right? So today I'm going to be showing you what our statement of financial position, also known as the balance sheet, is going to be looking like with those adjustments. Like I said from the onset, for you to understand the adjustment perfectly, at least you should have understood how to prepare a comprehensive income statement, financial position without adjustment, okay? Then you begin to take the adjustments one after the other. So for the questions, I'm going to be using I'm going to be going through I'll start with the non-current assets, then we'll bring in current assets, then I'm going to do what I'll adjust for working capital. That's current asset less current liabilities, okay? So that we'll adjust for working capital, then we'll add to non-current assets to give us capital employed, okay? So I'm going to be using that method, then I will add long-term liabilities to capital, of course. That's our equity items to give us our total finances, our total long-term finances, okay, for the business. We are preparing this account or this statement for XYZ Limited. Okay? So XYZ Limited. And what we are preparing right now is the statement of financial position. So I'm going to include that. So I'm going to start with my non-current assets. Like I said, we're not treating, this is step by step learning of adjustment. So it's just prepayment and accruals for now. We're not treating depreciation as at yet, okay? Nevertheless, I'll still show you how the account is to look like, okay? So I've suspended my zeros. And then, of course, whenever we're starting with non-current assets, the first column is for cost of the asset. The second column is for accumulated depreciation. And then the final column is for your net book value. So I'm going to be starting, like I said, with non-current assets. So we have non-current. So I'm starting with non-current assets. Okay. So the first thing we have is land and building. I can use L and B for land and building. So your land and building is 500,000. We don't have, like I said, there's no accumulated depreciation. So it is a dash. That means your net book value is still what? 500,000. We have equipment. And equipment is given to be 200,000. No depreciation, so we still have the same value as net book value. Okay, we have furnitures given to be 100,000. No depreciation, so the same value is our net book value. So total non-current assets, we can add this to give us 800,000. All right, now let's move on to our current assets. For current assets, we're going to start in the order of liquidity, okay? So I'm going to start with cash in hand, cash at bank, that particular order, and then we'll end with our closing stock. We'll start with our cash in hand, which is our cash here is given to be 1 million naira. That's the cash in hand, right? Now the bank here is showing an overdraft because, like I said, whenever we have a bank is an asset, it's supposed to be on the debit side, right? Now a bank balance is on the credit side. Automatically it means it's an overdraft, okay? So I can bring the overdraft here and just put it in bracket, or I can just take it over as a current liability. Any of the way, either way work. That means I'm saying you can bring bank here, bring the value of the overdraft, put it in bracket, or you can leave it out from the current asset, take it to current liability, and then show it there as a full liability, like as a current liability, okay? So I'm going to be taking it as a current liability, meaning I'm not going to be including it in the particular in the current asset listing. So I have cash in hand. The next current asset is going to be receivables. So we have receivables. We have our receivables value to be 445,000 naira, okay? We have 445,000. We have that there were some things that was due but not yet received, okay? We have commission of 150,000 that was due but not yet received. So like I said, that money belongs to us even though it's not yet received. At the end of the day, we have to reflect it as an asset. It belongs to us even though it's not with us. So I'm going to bring in commission that is due. Okay, so this is commission that is due. All right, it's due to us but not yet paid. 150,000. Remember, we have suspended zeros, okay? And then we are also told that we have expenses that were paid in advance. Okay, we talk about prepaid expenses as an asset and accrued income as an asset. Okay, so we have accrued income, commission that was due but not yet paid, and also we have expenses that was paid in advance. General expenses was paid in advance, so we have, that's what we call prepayment. So prepaid expenses, you can call them prepayment, or accrued expenses, call them what, accruals. Okay, now so I'm going to be using prepaid general expenses. So we have prepaid. So prepaid general expenses, as given in the equation, amounted to what, 3,000 naira. We have suspended zero. So I'm just bringing in our, now the last thing we're going to include is our what, inventory. Inventory, okay, that's our closing stock. So we have our closing inventory. Okay, and our closing inventory is given to be what, 350,000, 350. So we are adding 350,000. All right. So our total value for non-current assets is 1,948,000. Okay. Now I want to less current liability so I can arrive at working capital. So your current asset less current liability will give you your working capital, right? So let's check for our current liability. Okay, so current liabilities, we have payables, of course, one that we're supposed to have paid. Um, we have payables, we have bank overdraft. I talk about overdraft, right? Because the bank is showing the balance on the credit side in the trial balance. That means it's a liability. Only liabilities, income and capital can be on the credit side. So the bank, which is an asset, is showing a balance on the credit side. That is automatically it's an overdraft. Okay, so an overdraft now becomes what, a liability for you. And of course we have other liabilities from the additional information that was given. We have accrued expenses, right? Accrued expenses, and then we have prepaid income. That's income received in advance. So income received in advance, and then any accrued expenses are your liabilities. Now for the asset side, when you have prepaid expenses and then accrued income are your assets. Okay, so don't forget it. It's just more of a bit confusing. We have on the liability side, you have prepaid income, income that was received in advance, prepaid income, and then you have accrued expenses, prepaid income, accrued expenses as liabilities. When you come to your asset side, you have prepaid expenses, and accrued income as your assets. Okay, like I said, we have payables. Our payables amount as given on the credit side is 100,000. So we have 100,000. Yes. We have bank overdraft, and our bank overdraft is 500,000. Okay. We have like I said, we have prepaid income. Okay, prepaid income and accrued expenses. So let's go. Commission of 50,000 naira was received in advance, income received in advance. So that's a liability for us. So we'll talk about prepaid commission of 50,000, suspending three zeros, we are left with 50. Okay, and then we have accrued expenses, salaries we are owing. Okay, accrued salaries of 80,000 naira. So we have amounting to 80,000 naira. Okay, so this is how we do it. Commission due but not yet received is an asset. Now commission that was paid in advance is a liability. Okay, so what's our total liability? So our total current liability is 730,000. We are going to less it from the total current asset, which is this total current asset. Okay, so we are going to be lessing this from here, so that we are going to have our working capital. So we are lessing that. Now after lessening this, we arrive at a working capital of 1,218,000. This is the third column. That is automatically, this is where you have your total non-current asset. So we're going to be adding this value to the net book value of non-current asset. What you have will be capital employed. Okay, so this is 800,000 plus 1,218,000, and that will give us 2,018,000 as our capital employed. Okay, so this is our capital employed. Okay, or capital own or net asset. Okay, so this is it, our capital employed. And then now we have the asset must be capital plus liability, right? So we're going to bring in our equity item, and then if there's any long-term liability, because I did not bring in long-term liability, just current liability, so we'll have to add long-term liability to the equity item. Okay, so let's talk about equity. We have capital. Yes, capital is here, and then net profit, and of course we have drawings. Okay, we have capital, we have net profit, and then we have drawings. So far we don't have any long-term liabilities as given in the equation. There's no long-term liability, so the only source we have is just equity. So I'll be talking about equity. So we have capital, we have 2 million naira. I'll be adding the net profit figure of 1,518,000 naira. Okay, we're adding our net profit, and then of course we're going to less drawings. So drawings is given here to be 1,500,000. So we have to less drawings, right? So our drawings 1,500,000. All right. So don't forget we are lessing. We're not adding drawing. We're lessing drawings. Okay. So we're going to add 1, 2, and then less this. We're adding capital and the net profit, and of course we are lessing the drawings. Okay. So we have 2,000 plus this and then minus this to give us 2018. All right, so we're going to be having the same amount. Okay, that's, you have a balanced account for your capital employed and of course your equity. Okay, 2018, like I said, there's no long-term liabilities as given in the chart, in the illustration. So of course we're not going to be adding, but if they were long-term liabilities, you have to add them together with your equity item. Okay, so with this, we've come to the end of adjustment. Okay, when it has to do with accrued income, accrued expenses, prepaid income, and then prepaid expenses. Now in our next video we're going to be looking at depreciation, okay, and how it is treated, of course, in comprehensive income statement and in the statement of financial position. So if you're having challenges with how to treat depreciation, how to get accumulated depreciation, of course this channel is for you. Don't forget to subscribe to this channel if you haven't. Like this video, yes, if it was helpful to you. You can share with as many as you can so that they can get the knowledge that you also have acquired. Okay, and don't forget, click on the notification button so that when new videos drop, of course you'll be notified immediately. We'll see you in our next class. Thank you.